join with us. Hey, good morning, traders. It's Crash Alton. We're here on the 22nd of June, Saturday. I'm doing a little extra training for those in the Impact Trading Discord room. Welcome, everybody. Please feel free. This will be a session where I'll try to just go over some general concepts, get into a couple of details to help with a few things to maybe maximize some of our profits. Do a little bit of technical analysis, look at the ISNIPE chart a little bit, do a little bit of ATM strategy considerations, and then maybe a couple of structured trades that I kind of want you guys to pay attention to help us maximize catching some points during the day. All right. Before I start with my thing, though, I want to see if there is any pertinent questions, anything that's kind of, bugging you really want to know about, because it might tie into the discussion, and maybe I'll curtail that just a little bit more. So does anybody have something that they're struggling with or got a question with, or they don't understand about what we've been doing, or want some more clarification on something?
Yeah, I'll jump out there and say anything you can touch on with the fib would be great for me.
Fibs, okay. Anything else from anybody else?
I'd be curious on any sort of like slow movement consolidation type trading, kind of what you normally look for. I know it's a little bit more advanced, but it would be nice to kind of go into some of those slower times you look for.
Yep. Yep. Okay. I actually have part of that as my discussion today.
Another one would be knowing when to implement the right side pivot idea.
Right side pivot rule. Okay, we'll try to incorporate that in there.
Yeah, I guess that's all on the how to find the bottoms and catch a falling knife.
Yeah. Okay.
For me, it'd be sniping and when to enter, like best place to enter, because sometimes you're hitting the fractals. By the time it builds a fractal, it's already several points up.
Yep.
So just figuring out like the right times to do that.
Okay. All right. Anything else? All right. Well, good. Let's get started then. So I actually have almost all of that in here. I'll try to curtail maybe a little bit more of the bottom picking. It does tie in with some of the other stuff I'm talking about. All right, so let's look at charts. Let me share my screen here with everybody. If anybody else pops in, help me just to welcome them, just because people may come or go. All right, so everybody see my screen up here?
Yeah, we do.
All right, let's talk a little bit. We're going to go a little bit towards Felix's question initially, because that's kind of the direction I was going to start off with. I want to talk about being profitable and having good entries, good stops, good targets. And I think that obviously there is an issue, particularly with new people, on figuring out how to get in and then make a profit without the trade going against you. Now remember, we are doing something called learn to earn on the turn. Okay, we want confluence. We don't want to just take a blind trade hoping that it's going to end up doing what we want to do. So everything we want to do, 90% of the time, we want to stay in the direction of the trend, if possible. Okay. The second thing is we want confluence on almost all of our trades. So when we're looking at our 4-component system, as much component or as much confluence as we can get between the ISNIPE chart and the iStructure chart is fantastic. When we can add in bookmap, things like a fractal, okay, on a line, when we get a reversal here, and maybe we have a liquidity zone on bookmap, or maybe we have a market pulse VPI spike. There's 3 of us in here that have the bookmap, Matt and Tony. And they will help me calling those out. I did have a little bit of bookmap issues this last week, so I had to get that worked out. But we will try to make sure that we have confluence on the trades. All right. Again, that would be a reversal in price action. That would be having a fractal develop. that would be having a fractal developed on a good line, that would be having a fractal developed on a good line that's on liquidity zone that we call out in the room, and maybe a market pulse VPI, and then maybe we'll look at things like a trender and volume. So when I take this trade right here at the top, all those things I just said can add to confluence. All right, look at the trender, look at volume. I don't have volume on this chart because there's so many things to put on a chart that I could overdo it, and I don't want to overdo it. So maybe I'll end up putting volume on here, but it just takes up a lot of space to see volume bars, and then it takes away from the screen sharing space. So maybe it is that you take your own charts and you put up just like a 1 minute chart or something that you don't necessarily use just to watch the candles, but maybe you put some volume indications down under there, because I know that Matt specifically has said that this last week it has really helped him to be able to see volume when we have a change in direction or a bounce. So, and I think it's a great thing as well. So those we're always wanting to look for confluence, and that's my point. So that's number one, Felix, is make sure we have confluence when we take the trades. All right. The other thing is, and maybe I'll share this first. Let's do this. Let me get my PowerPoint, and I think what I'll do is I'll go into just a little bit of this first, and then we will go into this slide. So let's go slideshow from current slide. Okay, let's talk a little bit about ATM, and then we'll look at the specific entries and stuff. All right, so an ATM strategy for success is going to be based on several factors. The size of your account, whether it's prop or personal, but also taking into consideration, is it a personal account or is it a prop? Because there's different rules that will be dictated upon you by the prop firms if you're using prop money. You also have to take into consideration the volatility and the range of price action, right? On slow summer days, Matt's referring to this, wants to have some consideration on ATM strategies, getting in, getting out. We may need to make targets closer to our entry point, and I'm going to talk a little bit more about each one of these bullets as we go. On fast days, we might just be able to use our 8, 10, and 12, or even push our 12 out further because it's swinging, 10, 15, 20 points at a time. And so in the non-summer days or higher volatility days, it's much easier to make money. Our stops, no matter what we're going to do as far as targets, are always going to stay at 12, at least for now, until we have a little further discussion about risk management on another conversation. Your experience level, all right, your ability to see the spaghetti on the wall, see the forest through the trees, start understanding the rhythms as they bounce off of these ITS ATR lines, all right. Another factor is obviously we've seen in the last 4 to 6 weeks a lot of issues around the prop firm servers. And if the servers are causing delays, then that's gonna, or frozen, we're gonna have to take that in consideration. And then obviously while you're learning the system, all right, I want you to think about this. For every 1,000, you need to size in appropriately. And that's going to change depending on your personal prop account and that size of your account and your experience. While you're learning, I really, 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 really advise you train for 1 week, and you're able to get 5 out of 7 days green using this system with 3 micros, okay? Whether it's $100 or $50 a day, just be green. Just get to where you can control the targets and the risk management. And then you go from that to live money with 3 micros. And then just have 5 days out of 7 that are green days again. And then when you do that, then let's have another discussion about how many micros you can do, or whether you do minis or not. Now, a rule of thumb for me is that it's 1 micro per $1,000 of exposure that you can have. So if you have, for example, a $150,000 prop account, and it has a $5,000 intraday trailing stop, you don't really have a $150,000 account. You have a $5,000 account. All right, if you're doing a $75,000 account and you have a $3,000 intraday trailing stop, you don't have a $75,000 account. You only have $3,000 to play with. So take the number of dollars that you have to play with, that intraday trailing stop basically, and you use 1 micro for each one of those. So if you have $5,000 in a 150K prop account, that would be 5 times 3. All right, would be 15 micros max. And sorry, I've got a typo there. That 1 micro per 1,000 should say 3 micros per 1,000. Okay, so 3 times 5, 15. If you had the 75K with 3, then it would be 3 times 3. That would be 9 micros max per trade. I'll talk a little bit more about micros versus minis in just a second. While you're learning, okay, we already discussed that. Okay, let's talk about proper personal. Prop accounts, trade copy is a factor to contend with. Okay, when you're working with APEC and Rhythmics, as we have seen in the last 4 weeks, all right, since about mid-May, they made some changes to their servers. In my opinion, it feels like they put like a governor on it, all right, something that kind of slowed it down. I don't know what they did, but it has not been able to trade the same. I cannot trade as many accounts as I used to at one time with the number of micros. So I used to focus almost always on micros, because on a 150K account, I could have 150 micros. All right, so I could just leg in 10, 20, 30 of them at a time. But the problem is that now the downside with the micros, not necessarily when you're learning, but once you become more aggressive and more experienced, if you're trying to do anything, in my opinion, over 12 accounts trade copied at one time, you can't put on more than about 10 to 15 micros at a time because the system cannot handle it. If you start going to 30, 40, 50 micros like I used to do, it just completely freezes you up. I've lost multiple accounts from the systems freezing up and not being able to trade because you end up seeing price, along the your trade screen there where it shows your trades and everything. It starts going against you and you're hitting, sell, 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 and it's not doing anything except for going away. And then all of a sudden you've exceeded your $5,000 if it was a 150K account. So again, you got to be careful with what the data is doing. Night Owl just found out, which is part of the reason why I left NinjaTrader the other day. He found out that he had too many indicators on, and that on top of the issues with Apex servers was causing his NinjaTrader data to freeze or delay and to be slow. Now, I've told you this before, it's my personal opinion. I think Sierra Chart is a better platform. You're able to take all your processors, your processes can go across different cores on your computer system. You get updates faster. You can have 1,000 indicators on Sierra Chart compared to what you can have on NinjaTrader, and it just runs smoother. I used to get data delays all the time, freezing all the time. You can't control it. The only way you can control it is by reducing the number of indicators you have on your screen. And for me, I want all the indicators that I want to have on my screen. So if any of you are using NinjaTrader, and it may not be an Apex or Rhythmic server issue, it could be your own Ninja platform just being heavy with the number of stuff that you have on, the number of indicators. So it may be that you need to reduce the indicators. I literally had to go through a day where I took off one indicator at a time to figure out which one was causing the biggest delay. And it took hours and hours and hours, and it was so frustrating. So just think about that a little bit. Now with delayed data, whether it's because of Ninja servers or whatever, or maybe it's just, your own internet or something with the CME or the NYC, something, I don't know. You may just need to limit your number of micros. And in my opinion, with the sales that they've been having, particularly with Apex, I kind of think people should maybe test out having a 250K account, because you may end up being able to go to minis instead of micros. And so instead of having 30 micros, you could have 3 minis, right? 1 micro or 10 micros equals 1 mini. So in that case, if you're doing multiple larger accounts and you do the minis, it may help with the data delay issue because you don't have as much stuff moving around. For example, if you were to put on 3 minis versus 30 micros, according to Rhythmic, okay, if you were to move the stop on 30 micros, that all counts to them as a ding to their system. I've gotten these things called hard and soft warnings from Rhythmic. Even though I'm trading within the rules of the prop firm, if I have 50 micros on times 10 accounts, okay, that's 500 orders. 50 micros times 10 accounts, 500 orders. And then each one of those has 3 targets and a stop below it. So now I multiply each target and each stop loss in addition to the line that shows my order. And then let's say you put an auto trailing, or every time you move your stop or you move your target, all of those factors get counted by Rhythmic. And they can sit there and tell you, hey, you've got too many orders happening in too short of a period of time. So for a long time there, I had auto trailing stops, okay, on all those micros. So if it went up every 3 points on 50 micros times 10 accounts, that's 500. If I've got 20 accounts, now you're talking 1,000 orders and that are getting put in or flattened or sold all at one time. The server has a hard time with keeping up with it. So now you trade from micros to minis. If you're following me here, now I only have 3 targets times 3 minis and 1 stop for each one of them. You're less than a third of the number of moving parts per ordered trade on that bracket order that's flowing across the server. And Rhythmic literally tracks all of that. They track moving of the stops, moving of the targets, order entry, flattening, everything gets counted. And I've had hard violations for being considered like a high frequency trader, because I'd have 20 accounts with 50 micros, and maybe I did go flatten all at one time, or I hit the target all at one time, and they're telling me I'm high frequency trading, which I'm not really doing, but it's because of the number of the lot size that I have. So that's just something for consideration for you guys to understand as we move forward. The other thing about having minis instead of micros is that you have fewer commissions. The commissions are a little bit larger on the minis, but you got less of them, significantly less of them. So you actually end up saving some money. And if you've ever done your personal account and traded minis and micros, and you look at that statement from your broker, you'll see that there's a significant difference between trading a couple minis versus trading some micros, because as you know, there are multiple fees for every trade. Okay, your brokerage fee is probably actually one of the smallest fees. Then you get order routing fees on top of that. Then you get the exchange fees on top of that. So now you take all of that on 50 micros versus 5 minis. The commission structure, or what we call the all-in round-trip cost of a trade, is significantly less once you start moving to minis. The problem is while you're learning the program, I don't want you using minis because I don't want it blowing through lines on you. And now that something that could have been $100 or $200 controlled risk is $1,000 or $2,000 controlled risk. So, or maybe uncontrolled risk. So while you're learning, we use the minis, but our macros just starting off, but maybe it's something that you consider in the future. So I don't want to spend too much more time on that, but I hope that makes sense to everybody. Anybody have any questions on that? Anything I just said? Okay. Next one. Prop firm rules are an issue. So again, this comes back to, are you trading your personal account or your prop firm account? If you're trading your personal account, which I like to do in high volatility situations, all right, or if I'm starting to see my data freeze on my prop firm accounts, I go to my personal account in those high volatility or delayed data times, because I just don't have any issues with the order routing or data issues with Teton Denali exchange on Sierra Charts platform. And I don't have any dollar cost averaging rules that impact me as well. So let's say I got in on a 15 line and I was going long and it bounced against me down to the 20 line. I could dollar cost average at that 20 line below me and have, I put 5 micros in on the first leg, the 15, then I can go 5 micros on the 20 below me. Now I have 10 micros at a better dollar cost averaging location, but that could be violating the rules for the prop firms. The prop firms, particularly Apex, are monitoring this more closely now. They even admit in a video like 2 weeks ago that they hired 20 new people that are going to be looking into people's trading style, into what they do, and they are looking at whether people are doing dollar cost averaging. I know a guy that had a $40,000 payout that could not get paid because they said he dollar cost averaged on the trades. I've got a young lady that I trained on the ISNIPE system who did the same thing. She had 20 accounts. She passed 20 accounts in one day. She went to get a payout, and they told her that she couldn't get it on her payout because of dollar cost averaging. So some of this stuff is becoming an issue. Now, when you're doing what I do a lot, which is getting to what one of Matt's questions were, is trying to figure out where to get in on a slow process, all right, the price discovery can cause you to have to dollar cost average. So now if you're doing price discovery versus just bouncing off of lines, you're going to get into situations where you might end up having to dollar cost average a little bit more. And so you're going to not be able to do as much price discovery, okay, on the prop firm accounts as you could do on your own personal accounts, okay? Shabu, I see that you came in here. Take you off. Can you hear me, Stefan?
Yeah, no, I can.
Okay.
Hey, did they take person's accounts
Did they?
away
No.
for DCA?
No. Well, I've heard of two things. Yes, I've heard of violating the accounts. So the girl that I trained, she lost some of her accounts. The guy that I was talking about, he didn't lose his account, but they didn't give him his payout. So I think it's different situations. But here's my opinion, is that they can make up whatever rule they want that you said you broke, because you've probably broken a lot of rules while you're trading, right? So if they want to get you, they're going to get you on something, right? Their system, their rules that we have to work within. So you just have to be a little cautious on that. So let's talk a little bit more about price discovery. Okay, Matt, make sure I do this, and dollar cost averaging once I get to the charts here. All right, but I like to test the waters. I like to do price discovery because I want to get in on a 50-point move down at the bottom, and I'm going to show you some examples of this. All right, to help you, though, to not have issues with dollar cost averaging, you need to have really good entries, which is going to get to Felix's point, right? His question and what we're going to discuss. And you need to make sure that you get in the entry at a very good location so that you have the lowest price possible. And you want to make sure that you have confluence. Confluence. Because there will be more reaction at a point with confluence than a point without confluence. And you probably don't need to get dollar cost averaging done because you're getting a spring action. And that's what we're wanting off of most of our lines, is that spring away from that bull or bear ITS line in order to help you get that 8, 10, or 12 points as fast as possible. The best trade strategy to help you fight against dollar cost averaging and breaking the rules is the ISNIPE. Because our rules dictate that you don't really need the dollar cost average. Unless you're doing some kind of price discovery, you really don't need to do it. You enter into the trade, you put your stops at 12, all right? Once you move to 8 points or the opposite 4 line, you take your stops and you put them to just under the fractal that you entered into, okay? Just under the circle fractal. Now, let's just look at one trade, for example. This is called the 20 Eagle trade. I showed this, I think, last week. Not this week, but maybe the week before. here we are. This is on the 7th of June. Okay, we're following our lines down. We're looking for the next location of a trade that we can take to buy. On the ISNIPE chart on the left, we're coming down through the 4, through the 6, through the 10, okay, through the 15. No fractal on the 15. Now we're getting down to the 20 line. Okay, here it is, ITS Bull 20. When you see all these lines here for support and not as many lines up here, bear lines, you're in a bullish pattern, right? You can see we came with a blue background, have a momentary red while we're excurting for the retracing for the pullback. But look at the confluence here. Okay, the 20 eagle trade, it can either be the 15 or the 20 eagle trade. The 20 is the most powerful, the 15 would be the second. If this occurred on a 15 line, in the middle of a 15, okay, with the lines going across, then you would have the same kind of bounce, just might not be quite as powerful. But this 20 eagle trade, man, this is like so powerful. This thing went up 68 points like a rocket ship. And what are we doing? We're looking at both screens at the same time. So you get the fractal on the 20, and I get a fractal on the eagle. This occurs when the guns cloud crosses above the base cloud, and we end up getting separation between the clouds. So look at the distance from the Fox 2 line all the way over to the guns cloud and the price. The guns cloud is going skinny because price is just hovering right on there, very tight as it's going up vertically. All right, and then we hit some kind of daily target. So confluence for a fractal. We put this up here that's saying we were going to be targeting these areas, this rectangle. What do? We bounce back down, close this gap, so to speak, and then we have the combination of the 20 eagle where we spring right off. And how many points? We say 12 points, but honestly, most of the time, we don't need that much even for our trades. It's only if we're letting the trades in choppy type markets, run their course. Slow, choppy markets. But this is what we're looking for. And it may be that, and I'm going to talk about this in a second, it may be that you are still asking yourselves, well, I know all this, or I know the rules about the sniping, but I'm still not that profitable, or I'm actually red a lot of the time. Well, maybe we are over trading. Maybe you're trying to trade too many setups. Maybe you're doing too much counter trend trading. Maybe you need to reduce. If we have 20 trades on average, 25 trades on average a day on the ISNIPE, and we have 15, 16 different setups on iStructure, okay, you're talking, again, between 20 and 40 trade setups per day that we actually have. So maybe you need to reduce the number of trades, because before you came in here, I'm sure you weren't taking 20, 30 trades a day, most of you, all right? If you're using the bold bot like a lot of you are doing, you were doing 1, 2, 3 trades. If you're trading manually on your own, probably taking 3 or 4. Now you're coming into a sniping system like this that gives you so much opportunity. We start wanting to take everything, and we probably don't need to take everything. So be maybe more disciplined and more discreet or selective in what trades you are taking initially, again, until you learn the system a little bit better. Now, I can snipe this all day long. I can go up, down, up, down, up, down, up, down, up, down. That'll start eating away at your commissions, so you better have some profits in there that offset the commission. But like I am a super, super fast sniper. I can be in and out, in and out, in and out like crazy. So I take a ton of trades. I probably take more trades than anybody during the day because I'm doing that price discovery stuff and I'm just sniping all the time, particularly in slow markets when we're going sideways like this over here. I want to trade, so I'm going to do something over here. I'll show you some more of that in a second. But this is confluence.
Price discovery, is that like where you're calling the AM high and AM low?
No, price discovery is I'm in this consolidation pattern here, and I'm trying to discover whether it's going to bounce out of the bottom and go up to the top. Or I'm at the top, and I want to see if it's going to come back down. Price discovery would be I see this first candle over here on coming down to the eagle, but there's no fractal. But I'm asking myself, oh, maybe I'm getting a proximity trade, right? If it's really bullish, right? In bullish situations and uptrends, the fractal ends up being above the line a lot of times, okay? Above the line because it's so strong it doesn't come and touch your line. Well, does that mean because I stopped on this first, it stopped over here on the left, that that's not an eagle trade I want to take? No, I probably want to take that because just because I gave up the 3 points between these two candles from this left side to this right side, okay, I didn't get a fractal saying it went up. Well, how many points did that go up? Well, that went up 68 points. Because it didn't tag my eagle line by 3 points, it was 3 points above it. Do I not want to get in that trade? No. So for me, I might have, because I don't know what this candle's doing here on the right? Because that hasn't happened yet. I'm looking at this green candle on the left. This green candle on the left, it starts to bounce up first before I get this next one because it's going up. Then the next candle forms. It comes down, hits a tail, and then continues to go up. I might have laid in 3 right here. Let's say I didn't have ISNIPE. Okay? And I'm just not even looking at this. So I don't have the 20 line as confluence. I'm only looking at this. I might leg in 3 here. All right, and then I see it start to break out. Maybe I add another 5 here because I do see it starting to come up. And all this is a B, C pattern move. Impulse, retrace, continuation of trend. I want to get in on a 68-point move, so I might do 1 or 2 micros before I ever saw this fractal. Maybe the second line, the second 1 minute candle, does not have a fractal either. And maybe it's the right-sided pivot rule. So it comes down, but it's slightly higher low than the left 1 minute candle. I might leg in there too, but I don't want to give up that eagle trade because I know the results of eagle trades, that bouncing away guns cloud from the base cloud, coming back and having a retrace into the eagle. I want that. Price discovery may be that I know that we're in an uptrend because my clock. I know I'm going from an AM low to an AM high. I know that sometimes price can skirt through a price target. But I'm willing, because this is 10 points, let's say, I'm willing to do 1 micro here just to get in on the eagle. But let's say it skirts down to the pivot line right here. And that's 5 points below this line. So I'm price discovering because I know I'm going to get that pop off the eagle line just based off of my experience, based off of knowing what these patterns are. Price discovery says add 1 or 2 micros here. Oh, but and I don't have a fractal. Oh, but then it turns around and this candle comes down here, hits the pivot, and now bounces off pivot. Well, I have 2 choices. I can either take an immediate stop loss, which sometimes I do, and then just see it bounce here on the pivot again, and then I will buy 1 more time at the pivot. Or if I only took 1 or 2 micros here and it's coming 5 points against me, I'll just dollar cost average and add. Now maybe I only do 1 or 2 here, but maybe I add 5 more here, so I really bring the dollar cost averaging down. And then I get the bounce up. In my own trading, you see the Mustang line here, okay? When the Mustang line is inside of the Viper line, inside of the cloud, I will dollar cost average all the way to the Viper line. I will dollar cost here, I will dollar cost at the Mustang, and I will dollar cost at the Viper. Because maybe it's just coming down with a lot of thrust and then it's going to go back out. And that's just how I trade sometimes, because now instead of getting at the price up here at 82 and it came down here to the Mustang line, right on the pivot, now I'm getting in at 70. So I'm getting 12 points lower. So now that 68 point trade turned into 68, 78, 80 point trades, right? A 12 point difference. So that is 2 things. That is price discovery and that's dollar cost averaging. Now, when you have the confluence between the two, you don't really have to do so much. So, man, I see a pivot here and I see a pivot here. Boom, I am loading up. Instead of 3 micros, I'm probably taking 10 micros. All right, because that is such a powerful trade. So, do you understand? Now let's say this came shooting through. Let's just say, oh, I see the 20. And it just did this little, and it came back down here to the 31 line. And you had your stops down here at 12, and it's starting to come back down against you, and you couldn't move it. Now you have to ask yourself, if it drops back below here, am I fast enough to hit exit, flatten all, and then wait until it comes down to the next line, builds a fractal, and then buy it again? Or do I dollar cost average? Now, I probably won't dollar cost average beyond a 20 line to the larger 31, 45, 60s. That's a pretty big difference. But I tell you what, I do sometimes dollar cost average between a 10 and a 15 and a 15 and a 20. Okay, I will dollar cost average inside of these. Outside of the 20, I don't really dollar cost average too much. I would rather hit, flatten all, let it come back down, build another fractal. I conserved my money. I still have bullets in the chamber because I only took a very small loss, if anything at all. Then it comes back, buy it again, and then go. So if it's your personal account and you can DCA, fine. Now, Daryl Martin from Apex did make another video because people started freaking out and panicking. He's like, I don't want you guys to freak out and panic. The rules have always been there, but I will let you do one DCA. And he goes, I'm not going to give you how many points away that it can be, and I'm not going to tell you how many more you can add. I'm going to leave that up to you, but I do have some rules around the risk reward. So he usually doesn't want you, to do more than a 1 to 3. So if you're only trying to get 1 point, he doesn't want you to have more than 3 points of risk. If you're trying to get 5 points, he doesn't want you to have more than like a 15-point stop, 15 to 20. That's kind of his rules he's looking at when he's talking about dollar cost averaging and controlling risk management. So you have to take that in consideration in the accounts that you're trading based off the prop firm or personal accounts that you're using. So now, that's enough of the discussion. We'll hit on some more of this, but I want to go to the next stuff. Okay, let's talk about volatility. This is really important. This also goes in conjunction with what Matt was asking. Slow days versus fast days. Okay, the summers are just slow. Unfortunately, a lot of you guys are joining in the summer month, the beginning. And May actually is one of the worst months to trade because they do, just for some reason, start having a reduced range starting in May, right away. Everybody, the Wall Street firms, part of why that is because in May, the Wall Street firms start hedging more. Okay? They start waiting for pullbacks. They trade less. They hedge to the downside. And a lot of it has to do with rolling into a dip before Christmas time. Because then what everybody wants to do is buy the Santa Claus rally coming into November and December. So that old saying, sell in May, go away. Well, it's really hedge in May, slow down your trading. Because that's kind of what's happening with Wall Street. Less volume because people are taking vacation, whether it's retail or Wall Street. The algorithms just become a little more restrictive. So how do we measure volatility? I've talked about this in the room, and I do it by 2 ways. I measure volatility on a 1-minute time frame. Okay? Figure out how many points a minute we are trading on the NQ. So this is for the NQ. Excuse me. If we are slow and you see less than 10 points per minute, okay, we're probably up here doing something like this, okay? Or we're trading around the point of control. Or we're between a time frame change, so coming up from an AM high down to an AM low. So we're just kind of consolidating before the rollover, okay? We get into this Wyckoff spring and then we spring down. So the 3 times you're really going to see this is kind of in this Wyckoff spring consolidation area is around the point of control, around reversal trends from lows to highs, okay? And if you're below 10, you're slow. I will do a lot of price discovery action when I'm less than 10 points per minute. On average, if you're in that good range of 10 to 17, that's a pretty good range to be bouncing around, right? I would like it to be like 12 to 17 to really get these 8 to 10, 12 points here. If you're trading fast, okay, high volatility news events, not like FOMC, but just other news events, you're going to be trading 18 to 25. You get those FOMC news events, the Treasury events, some world economic disaster, you're getting above 25 points. That means, you got your 12-point stop in there, and it just bounces down and snags that 12 points like nobody's business. So that's when you probably don't want to really be having that large of trades on, or don't be trading at all. That's kind of my rule. If you see greater than 25, then don't trade. Now, the VIX is the second component by which I measure volatility. It does have to be relative to its near-term history. But in general, okay, and we've been under 18 for a very long time. In general, when the VIX is above 15 and it starts going above 18, now you're getting into that whipsaw time frame, and it might be time to not trade. So monitor the VIX and the 18. When will volatility occur more on the VIX? Maybe when it's hitting its 50 or its 61.8% Fibonacci levels, because it's getting ready to have a bounce or a reaction off of its Fibonacci levels. So it might be at 13 or 14 on the VIX right now, but we're getting to a reflection point in price that would cause the VIX to have some kind of move that will create more volatility, even though we're not above 15. Does that make sense to everybody?
What does VIX stand for?
That is the volatility index. Okay, it is depending on which platform you're on. It is either the VIX or the $VIX. And for us on Sierra chart, I'll look it up and send it to you. I think it's just actually VIX underscore like GCI or something. I'll have to look it up again. But that's how we measure volatility. Okay. What are we doing about volatility and speed with our stops? Nothing. Keep your stops at 12. Okay. When it bounces, because we're using confluence. We're not catching that falling knife. We're looking to learn on the turn. So we're only taking a trade once it starts to go where we want it to. So we're able to keep the stops at 12. All right. Now, volatility based off range of price action and how much should we trade. We trade the NQ and the MNQ predominantly in this room because of the range we get and the rhythms we see. Yes, you can change this to work on gold, the snipe lines, on gold, which is GC, oil, which is CL, the ES, the YM, the Russell, any of those. It works. But the rhythms that have been back tested that show the highest winning rate actually occur on the NQ. And it's just because it's that Tasmanian devil that likes to have range. It likes to trade in range. I told you yesterday, right? We like to see 20-point, 30-point ranges on the sniping. We looked 30, 50, 70, and 100-point ranges on the iStructure chart. It works in those kind of rhythms. And because of that, right, then we know what we can use for targets. That's where we got the 8, 10, and 12 originally. Now, while we're trading the micros, if we're on a slow summer day, or Felix, or like Brent this last week, or a couple other people told me they're just not getting the profits that they want. They're taking a few more losses, and they're not getting in. So what I did with a couple people, and Felix, for you today, all right, let's talk about this. If it's slow, you got to move your your targets closer to your entry leg location. So instead of 8 points, maybe it's 3 points. Instead of 10 points, maybe it's 5 points. Instead of 12 points, maybe it's 7 points. Because price is only moving at 5 points per minute. We're sub 10, right? On the 1 minute ATR. If you still want to make money and you want to take a chance on those trades, but it's never going to go to 20 points away from us, it's going to go to 7 points and then come back down, we can still make profit if the market is only moving 3 to 7 points. Okay? If it is, we'll take that. So we adjust our stops, okay? So here's the strategy that I'm going to show you that you can practice using. Aside from moving your stops closer, you can then change the size of the number of micro lots that you're using. If you're only moving 5 to 7 points per minute, then maybe I want to trade more than 3 micros so I can grab a little bit more money. If I'm only going to go 12 ticks, all right, now this is important. You guys got to understand. Like in Sierra chart, they give you the option of putting your targets in ticks, not in points, okay? I can do it by price. I can do it by ticks. I don't remember exactly how it is in NinjaTrader. I got to be honest with you. But you got to know this, right? If you guys are going to come in here and trade, you've got to act like you're professionals, and you've got to know the information that we are teaching. The stuff that's going to make you win or lose money, you've got to understand. So make sure you understand that there are 4 ticks per point. And I don't want you to get them mixed up, because people have come into this room in the last 2 weeks and did not understand the difference. They were used to working on ticks. I was talking points. So I said 3 points, and a couple people thought I was saying 3 ticks. That's less than a point. Understand the difference. 4 ticks per point. So on a slow day, if I'm doing price discovery in a Wyckoff spring area, all right, a consolidation area, then I may want to do like 10 micros. And I'm going to put 3 at 3 points, 3 at 5, 2 at 7, and then I'll leave 2 runners in case I get a breakout of that Wyckoff spring. And this is what I do all day long, lots of times, okay? And I'll show you a couple examples here. But 3 points is a lot different than 8 points. 5 is a lot different than 10, and 7 is different than 12. But then I leave myself more runners because I'm taking stuff off so early. I'm putting money in the bank, taking from the banker, pocketing it, and then seeing if I can get runners that will continue with a breakout. If not, I either hit close at the top of the Wyckoff spring rectangle that I draw all the time, or I let it come down and hit my stop. Maybe I've raised my stop. Just there's a lot of different points we can talk about that. Or if you're going to be trading the minis, I know Brent, right? He's not in here today, but he just likes trading the minis. Okay, he's on 250K accounts, and he wants to do minis. What we did with him is we changed him from 8, 10, and 12 to like 3, 5, and then to have 1 as a runner. So he's bagging a mini at 3 points, bagging a mini at 5 points, all right, and then hoping to catch a runner with his last one, because he doesn't have his mini to leg out on because he's only got 3. So he puts his last one at like 25 points, and then if he needs to, he'll either go flat and all, raise his stop up, or pull his target down off his chart. Any questions on this so far?
No.
Okay, let's go to the next slide. So now, what would that look like?
Sorry, hey, took a second for my mic to come off mute. On that, is your stop loss still 12 points?
Yes.
Oh, sorry, I just saw that.
Yep,
Okay.
no problem.
Well,
Yep, no, but here, what are you going to do? When it hits 5 points, okay, you're going really slow. When it hits 5 points, you got to bring it to your entry to the fractal.
Yeah.
So I'm still using, remember I would do like 8 points. So let's say you got in late. Now part of why I picked 5, 3, and 7 is because let's assume we're still looking for 8, 10, and 12, but you get in 5 points late by the time your eye-hand coordination sees the fractal and you hit buy. So I'm giving you 5 points maybe also. So let's say it's a normal range today, but you're still losing. Instead of having 8, right, I took off 5 points. I'm giving you 3 to still try to get at least 3 points off of that. So it kind of works either on a slow day or it works on a regular day, but you're just kind of delayed in your entry. Either way, around the 5 point turn, okay, the 5 to 8 point turn, you got to bring your stops up to where your entry is, right below the fractal ball. Now, the way it looks in Sierra chart, okay, I'll put on 10 micros at, like I told you, 12, 20, and 28. 12, 20, 28. That's the number of ticks corresponding to the points. Okay, 12-point stop is 48 ticks. Okay, and you can see that I have stop 1, which matches to the 12-point. I put on like a 40-tick stop. Now, sometimes I don't do all of them at 48. And the reason I don't do all of them at 48 is because I trade off my chart, and for every one of these, I see a line. So I see one stop loss line, I see another line, I see another line. So I might separate them by a couple ticks so I can see the lines individually. So if I want to grab one of them and move it, I can. You can do whatever you want. If you just want them all to be at 48, put them all at 48. No big deal. I just sometimes put, and I have a couple different setups. Some of them are all at 48. And then a couple of them, like when I do this, I have them 40, 44, 48, and 50 just to set it off differently. So I can just see them separated on the screen. Now, you need to understand this. This is a typical target where I am saying you take it off at a limit order of whatever that price is set at. This is a stop limit set at a set price. This, okay, I do 2 of these, sometimes particularly on news or really volatile situations. I do want a auto trailing stop that is triggered by something, and it brings my stops up automatically for me. So it's almost like using a robot, because it'll just, if price just springs away from me 10 points, this will spring up with it on these 2. All right, and I can keep it offset by like 20, 25 points. So if it jumped up 40 points out of the blue, I would trail that stop by 20. So I just see the stop loss line going, just triggering all the way up, following price. So this is one example of what this would look like inside of Sierra chart. But you need to read the definitions within Ninja or Sierra, whatever your trading platform is, to understand how to program trailing stop limits, okay, or break-even offsets. Not going into that today, just showing you that there are other things you can do besides just simple limit targets and stop limit orders. Okay, now, we already talked about this. One comment about this. Remember I told you that Rhythmic has a hard time processing a lot of orders at one time. If I was putting on 50 lots on 20 accounts and these auto trailing stops are going on all 500 of my lots, okay, as they're going up, I'm going to get a soft violation at times from Rhythmic. Soft violation says they're giving you a warning, they're not disconnecting you. A hard violation is they literally disconnect you from the Rhythmic server. And I've had that happen like 4 times. Okay, I'm in the middle of a trade. Matt's been with me. I was on a $125,000 trade in one day. And they hard stopped me. Hard stopped me. I had $125,000 profit off my accounts. Okay, you don't want to have $125,000 profit and then get hard stopped. So you got to know what the rules are, and you got to work within them. So if you're having a lot of volatility or you're doing a lot of lots, you can't do the auto trailing stops on those prop firm accounts, okay, unless you're trading less than about 10 copy accounts. Otherwise, you're going to freeze or get a hard reset. So don't do that. All right, what if my P&L, Felix, is not as great and I keep losing? All right, we've kind of already incorporated these conversations, but realize that the impact trading system that I am showing you, okay, it provides both excellent P&L and win rate. And because of that, it enables us to take the emotions out of trading. No fear, no greed. Base hit after base hit after base hit. 1% a day, 1% a day, 1% a day. Did I show you guys this yet? Okay, let's do this. If you have not looked at this, I just want to make sure that you guys see this. All right, can everybody see the Discord room? make sure that it
Go ahead.
Okay. Here's a daily compound interest calculator that I put inside the education room. All right. If you have an initial value of $10,000, just $10,000, okay, $10,000, and you get 1% a day growth using this system, okay. First of all, $10,000, okay. If you want 1% growth off of $10,000, how much money profit is that per day?
$100.
Okay.
Buck.
Huh? $10,000 times 1%. $100. Okay. So we're asking you to make $100 a day off of $10,000. Most of you, no matter what size account you're using for prop firms, 50, 75, you guys are looking to make 100 or $200 a day, right? When you were doing the bold bot, you were looking for 100, $200 a day across, 5 accounts. It'd be $100 times 5, $500. 2 times 5, you get 1,000. Well, if you're making 1% a day off of $10,000 at the end of 1 year, if you're trading 20 trading days a month, you're going to turn $10,000 only by 1% into $109,000. You got to understand compounding interest. Now, that is assuming you're leaving the money in the account. So if you take money out, yes, that's going to be a little bit of an issue. But the point of the story is when you take the impact system, okay, along with compounding interest, it takes the emotions out of trading. When we have 20 to 30 trades a day, we don't have to capture every single trade. Okay? So that means you don't have the fear of missing out. That means you can have a little more discretion in what you're trying to do. So learn this and study the system. This is up to you. You must apply what we have been teaching. Fear. I've talked to a couple people this week about fear and greed. Some of them are not taking the setups because they're so worried about finding all the confluence and making sure that the fractal got there and, oh, is this the right line? That then now they're 10 points off the trade instead of, 2 or 3 points after the trade has appeared to us. You're going to miss 100% of the shots you don't take. That's why I want you also to start off in sim. That's why I want you to start off using micros, because take the fear out of it when you don't have a lot of risk and set up the habit patterns. Brain, eyes, brain, hand. Eyes, brain, hand. Eyes, brain, hand. Get into that pattern. Okay? Repeat, repetition, repetition, repetition. Will get you to be able to take the setups faster, quicker. You cannot have the fear because we know of missing out and chasing it because we know there'll be the next trade. You don't have to have the fear of taking the trade itself because we know we have a system that gives you a 78% win rate. And if you're only using micros to begin with, you're really not going to lose that much. So take them quickly, and don't be afraid to get out if you have to get out. Now, greed is also an issue. People are over trading. When is the times that everybody is over trading? The first 45 minutes. Okay. Now, what happened on Thursday? Somebody tell me what kind of day Thursday was overall. This Thursday. Up or down?
It was up.
Thursday was?
Was it?
was a sell-off.
No, it dropped like a rock.
It was a 400-point sell-off.
Oh, it did. Okay. All right. My bad.
That's all right. It's Saturday. We all get groggy out. Days run together. Here's the point. In that first 45 minutes, we dropped like 300 points. Okay? And there's going to be days that you're just not going to get in some of the trades. And you may have to, it may be going so fast or you can't figure out what the heck's going on because it's just dropping like a rock. Or you think, oh, it's just doing a normal little rotation low from an AM low to AM high. And then it just keeps going and it keeps going and it keeps going and it keeps accelerating. And then you're like, dang, I just missed 300 points. Well, that drop, after the first 45 minutes to an hour, maybe it was an hour and a half. It gave us some opportunities in there to trade. Don't be afraid just because it's taking an elevator up or down that you're not going to be getting it. If it's taking an elevator up or down, don't get greedy. Wait patiently. Don't catch a falling knife or a shooting star. Let things develop to where it gets normal rhythm cycles to where we can just start trading. Remember, we still have, okay, on Thursday we had 18, I did it last night, I'm going to show it to you. We had 18 trades that we could have taken on our conservative rules on Thursday, even though it went straight down. 18. And we're sitting here probably going, gosh, I just really missed out on almost all of that and I couldn't trade. Well, pay attention to the rules because they give you the opportunity to trade. The other time that they're over trading is the last hour and then in the slog. Now in the slog, Matt, is the time where I might do more price discovery because we're going slow. We're usually around the point of control and we're in some kind of consolidation setup. So that's when I start sniping up and down, up and down, up and down. Okay? When that happens, okay, when you're losing money, don't trade with too much size. When you're doing good, add to your size. All right? Paul Tudor Jones, I put this quote in here this last week. Decrease your trading volume when you're trading poorly. Increase your volume when you're trading well. When the rhythms are there and you're feeling it, trade the volume. When it's not, if you had a couple losses, pull back. Go to sim. Don't trade. Observe. Remember, red over red, you're dead. If you're seeing it smoking down with red candles or red background and we're just doing 4s and 6s, 4s and 6s, 4s and 6s, don't try to counter trend trade in that down rhythm. You got to understand the rhythm and don't be counter trend trading or using too much lot size and over trading in those kind of rhythms. All right, now let's get to this example.
The sounds on your chart. One thing I think I noticed is, like, let's say I'm looking at getting in on like a 15 or a 20 to go either long or short, but then I'm hearing the tick, 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 tick going like real fast. And I'm like, oh crap, that actually means it's going to keep going long or short and not develop a fractal. Am I kind of correct in saying that, or?
It could be, yes. So let's say that we are doing this trade right here. Okay, we're back to this one. So what happens, Stefan, is that the market is kind of rolling over here, and then it does roll over, and look at this. This is called a V-shaped recovery. So it's an impulse move down, impulse move up. So you'll hear two different sounds here. You're going to hear the ticker sounds, and the ticker sounds actually sound slightly different going down versus going up. So I challenge you to pay very close attention moving forward to see if you can decipher the sound of going down and up. Now, no matter what, you're going to hear the sound of going down here. But what I want to teach you is the rhythms. What are they doing? Well, they come down here, they're bouncing around, and now people that have been long from down here are raising their stops up. Okay? They're chasing price up, and they're rolling their stops up. What do the market makers want? What are the people who are playing opposite you wanting? As you're bringing your stops up, they want to all of a sudden flush it down, take your stops, take you out of the trade, take your money, and then it's going to do what it was doing anyways that you thought it was going to do. Let's say this is an ABC pattern. A, B, C. Impulse move up, retrace, continuation of trade. That's what it is. Move up, consolidate, retrace, continuation of the trade. What they want to do is this is going to come on higher volume. If you had volume bars down here, you would see higher volume, bigger red candles down here, volume candles growing. If you had an indicator like Bookmap, they will show you what they call sweep orders coming down into the stops down here. So they know there's 500 stops right here, and they sell sweep it on high volume, and so you're getting that, but then it hits our fractal, our line, okay, and then it goes, and then it goes So the sound reverses, and it reverses off of that. So yes, you are hearing correctly. You're hearing that sell volume to come down because this is an impulse move, a sweep. We call it a sweep down to take people's stops, and then a reversal to continue the trend. This is there's videos, you can Google search this. Matter of fact, I'll find one and I'll put it in our education. There's a video that the dude actually explains this really well of how the pros they know where the money is, they know where the stops are, the algorithms can see it. And they're going to come sweep down on high volume, snag it before you can move it, and then continue on without you. But our system is designed to understand that. So it may be...
But normally I would try to get in on that 15 there instead of waiting for it to go down to the 20. But if I hear that sound, I'm like, no, something's going on.
Okay, well, okay, so maybe either don't listen to the sound or understand what the sound might do. A lot of times you're going to get that flush, you're going to get that sound, and it's going to reverse. So you can actually use that to say, hey, they might be doing a sell sweep into sell stops and a reversal. But back whatever you're hearing up with, just know that, yeah, it can keep going. If you're seeing that on the 4s and 6s, okay, I'll show you an example. 4s and 6s, 4s and 6s, 4s and 6s, and it just keeps bouncing off those, yeah, we're probably going to continue to sell off. If you're seeing this with flat lines, okay, and we're not just doing a ton of 4s and 6s, and we're just kind of rolling over here, and you're seeing this big, huge, look, you got 4, 6, 10, 15, 20, 31, 35, and 45 all below you. This should tell you that it's got some strength in the market. You only have a little bit of bear lines above you. So now this is the next step of understanding ISNIPE. You've got to start looking at what you're seeing, the spaghetti on the walls. Do I see more support or more resistance? Well, I see a lot more support. Well, what has the trend been? The trend has been up. If I'm separating from my clouds this far, I know at some point when I hit a high target, I've got to probably have some kind of retrace, regroup, let people get into their longs. Here's another saying, okay? Wall Street always wants its fill. No, it doesn't. That's not that. Wall Street always gets its fill. Not wants, gets. That's a literal saying on Wall Street. Wall Street always gets its fill. Here's an example. Some of the traders on Wall Street didn't get in on this climb. So what do? They sell it to buy it. Sell it to buy it. Take people out, take their money, and then continuation to trend. So buying, they might have missed out. Maybe they missed the signal. Well, they will then heavily start trying to sell it, knowing that they want it at a cheaper rate, at a cheaper price. What do they get people do? They get people to flush their orders. Oh, price is going against me. Everybody's getting out. So now they flush the orders down, scare them out. Now they buy down here knowing that they have price targets that they want to get back in. So here's an example of an ABC pattern. Okay? Flag, impulse, move up, retrace, continuation to trend. There's all ways to look at this. But they got their fill. Same thing on a gap fill. Why do they go get the gap fill? Because some of them missed the trade. And so if the market went up overnight while the Europeans were trading, well, the Wall Street traders in America are like, we don't want the Europeans to go straight up 400 points without us. So the Europeans climbed overnight 200-300 points. Well, now we come into the RTH hours, and the Wall Street guys like, screw that. We're selling it short, and we're going to get a pullback, and then we're going to buy it, and then we're going to climb another 100-200 points while we're in it. So now we're making money on the way down, scaring everybody out, taking their money, and then we buy the crap out of this, and that's why you get this kind of move, because now Wall Street got its fill, and now they're moving up again. Same thing happening here. They sell them to buy them. So understand the psychology of the market. You will get the sound telling you that they're selling them, but how do you get, what's your safety net? Your safety net is a change in direction on the line with a fractal, and now you have it on two different charts at two major points. The biggest line on this entire chart is the 20. The biggest line on here is the eagle. Everything's around the eagle. Everything's around the 20. Does that make sense, Stefan?
Yes.
Okay. Now, let's get in some applicability here. So this is geared towards Matt and Felix and anybody who's struggling on entry and exits. Here we are. Our rules say that we can trade, okay, at after 7 o'clock. At 7:25 is when you can start taking the 10s. So what am I looking at 7 o'clock Pacific Standard Time? The market opens for me 6:30 Pacific Standard Time. We're on a Pacific Standard Time chart. At 7 o'clock, 7 o'clock. Okay, here's 7 o'clock. Here's price. I'm now looking for the next 15 line. Oh, here's a 10. Nope, can't do that. Okay, here's a 15. Valid trade entry? Yes. Valid trade? Well, the question is, did it go 10 points and was it a successful trade? No. Why? Well, because we just did an impulse move up, and I'm not looking to the left much. I'm just saying, we're kind of doing this impulse move up. I just changed from red candles to cyan to green. Do I want to take this trade? I don't know, but let's say you do. So yes, you take it. Where would your stops be after it moves? 8 points. Now I'm gonna make this a little bigger so it looks more realistic, like what it is like when we're trading, so you can kind of see price. Okay, how many points is that? Okay, that's right about 8 points. So if you got in 5 late, you get in 3, your stop would come back and you have your stop right here, right above this fractal. So in this case, yeah, not the best trade. I may have lost some money on that one. Okay, when's the next line? Okay, well, let's just look at this. What line is this? This is the 15, this is 20. Just out of curiosity, let's just calculate how many points are from line to line on this one. Okay. There's 12.25. Remember I said sometimes I'll dollar cost average from one if I make a mistake, and then I'll just go to the next one and then look what price does. It does go in the direction that I think it's going to do. Well, this would be an example of dollar cost average. You could either get here, you put your stop right above here, price comes up, you're not able to take anything, it's reversing against you. You either just decide, oh, it's reversing against me, it's coming and hitting this line again. I either hit stop out or I leave my line and I stay just disciplined to the rules, and my stop was right there, and I get stopped out 2 points. Okay, I lost 2 on that one. Well, now I come back up here. Well, that's the next line in order. Look at the fractal there. It bounces, comes down. Okay, it did a 45-point move. My stop's up here at 8 points. When it moves 8 points away from me, or the opposite 4 line, my stop comes to above the line. Just above the line. Right there. Now, we know that it likes to back and fill. This one would have been close. I don't know whether this would have stopped us out or not. It just depends on exactly where your stop is. Let's say it did do that, bounced up, and you see this big tail. And then you see it starting to come back around. And then you see a 4 and a 6 develop. Well, you can sit there and tell yourself, once you get a little more advanced and you're seeing the forest through the trees here, man, I might short that again. Now I get in somewhere down here and can chase it a little bit, right? Knowing that my stop would still be above here. So this is an example of dollar cost averaging. Let's say that I took this trade. Actually, we'll do this in a second. Well, let's understand adding versus dollar cost averaging. If I bought this and then I didn't get stopped out because I had my stop at 12 up here, and then it comes up here and I add to this location, that's called dollar cost averaging because price has gone away from me. If I take this trade and I see it pull back, come up here and bounce a second time, and now I see it coming down through this battle line here at the top of the cloud, and I added right here. This is called adding to a position. This is not against the rules for like Apex. So this is adding versus dollar cost averaging. Now, let's follow the next line just briefly. Let's go through a couple of these really, really quick because I have a lot of points I want to explain on this stuff. Price is coming down through here. It's not 7:30 yet, so I don't even look at the 10. Now I'm coming back to the next, 15 line? Do I get a fractal here? No, don't take the trade. Looking for the next line I can take. Up, here's 730. Now I can take a 10. Where do I place my stops once it goes 8 points away from me? Valid trade, valid entry, yes. I would have put my stops where? I would put my stops right here. Right on top of that fractal. After it moved 8 points from the line, I put my stop right on top of the fractal. This one, I would have hopefully gotten some points out. It would come back here. Could have stopped you out most likely on that one. So now you got a partial trade. Okay, I got a partial trade. Now I'm coming down to the next line. Come down here. Take the first touch. Where's my line? Okay, I have 12 points. Minus 12. I bounce up. I come down. I do not come next here. Let's just say that was 8 points. Where's my stop? Right below the line. It did its little, I'm going to take your stops out away from you. Well, it didn't get us on this one. So now we end up getting to have a higher price target. This move, right, for sure got us from the line up to here. All right, that's a 22-point move. It looks smaller than that when you're consolidated like this. That's 22 points. We can take 3, 5, 7 points out of that all day long without ever getting stopped out. Okay, got barely stopped out, but got a partial trade. Didn't get stopped out, got a full trade. Okay, now I'm looking for my next line. Looking for my next line. I'm trying to remember why I was talking about fractal, no fractal here. Here's another thought. These candles are color-coded for strength or weakness. I do have a friend that I taught this to who does not use fractals. I don't like doing it this way. Okay, I don't like doing it this way. But he uses no fractals, and he uses green and red candles. So when the candle's coming down red and it turns green, on the second candle that turns green, he hits the buy program. Now, if you're having difficulty and these lines are not that great for you, you could change them from green to red, just normal buy and sell candles. The difference is, though, is that he waits to the second for confirmation. His confirmation is a second green candle. Closed. So that is basically the same thing as a fractal develop. So in my opinion, it doesn't help to do that. But you could potentially, if you have this system on your own chart, you could potentially change the candles from red to green to see if that helps you with seeing red candles coming down, green candles going up. Just a point.
Does it do the same thing with red candles, or he just does?
Say that again?
Does he do the same thing with red candles, or he just does it with green?
No, same thing. So if it was coming up, he would see green candles, and then when it turns to a second red candle, he would sell. Now,
Okay.
I've tested it, and it's almost the exact same location when the fractal develops. So to me, the fractal helps identify hitting the line and seeing the reversal better. So that's why I use the fractals. I prefer the fractal method because it's an eye magnet. Yes, I'm having a little wick with a change. So you can do whatever you want. I'm just throwing that out there. So now the next line, coming. Next line's coming down here. All right, I've already hit the 10 up there. Okay, so that's not a line. That's not a line. I've already hit this one, so now I come down here. Here I buy. Valid trade, valid setup, yes. Now I come back down, I flush down here. Now, what's interesting is, just look at this for a second. Let's just look at rhythms. How many points from here on the NASDAQ up? 40 points. Down. 40 points. Huh. Up 46 points. Down 46 points. Down from this one big move to the next move? 73 points. Big move down to big move up. Or sorry, that one was 75 points. Down, up, 73, 74 points. Start noticing the rhythms in the NQ on these moves. Helps you start to feel where the market is and where it might go. Now I'm bottoming out. There's no fractal here. There's no indication for me to take a trade down here. So what do I have to wait for? I have to wait for a 4 and a 6 to develop. All right. I have to wait for, if I'm brand new, for a 10. The reason you want to start understanding this concept sooner than later is because I do want you to get to the point of taking the first touch of the 6. I only am making it conservative for you at the beginning. And there's a lot of reasons to take the 6s. Okay? But you have to know when to take the 6s. And this is what I'm going to explain to you. Okay? Look at this pattern here. 75 points down, 75 points up. A little more of a V shape. A little more of a vertical line of the 4, the 6, and the 10, all developing. They're not flat across the top like this. Okay? They're not flat. They're more vertical. The more vertical and the closer together the lines are, the more it means it's an impulse move. The more it means it's an impulse move, it means we probably want to catch, it means 2 things. Make sure you write this down. Understand this. When we see an impulse move, we want to, number 1, we want to be able to catch the first 6 retracement for the continuation of the trend. Because if I'm waiting to the 10, now I have to wait 50 points before I can get in on something.
But the fractal doesn't develop till the second candle, though, right? So go back to the one you right there.
Here?
So that first, no, up, go up a little. The purple circle where you have it right there.
Yeah.
But that fractal is not going to develop until the second candle, though, right? So you have the, like those two are right next to each other.
Yep.
But the first one's not going to be developed until the second candle starts, though, right? So don't you have to wait for it to come down? So technically, isn't that the second touch?
Well,
There's
technically,
2 circles next to each other.
Yeah,
Those 2 fractals.
yeah, okay. So technically, okay, this is the first touch of the 6. What I was,
Okay, got it.
what I was showing, what I'm actually showing in here is a right-sided pivot roll off the 6. So
Okay, let's see the first touch, though.
So let's expand this out a little bit. Okay, impulse move up. Pull back to the 6. How many points do I want? I want at least 10 points. Okay, I actually got 12 on this one because, you know, it looks smaller when I'm condensed. I actually got 12 points.
But the fractal develops late.
Yeah, it develops. Okay, Stefan, hold on. Hold on.
Okay.
Yes, let's say the fractal develops right here. Okay, let's just say it develops right there. Well, no, let's get nitpicky. Okay, I don't want that. The fractal develops on the second candle, which is right here where this green line is. You see that? That's the second candle developing. So that's when you're going to have the fractal. So it's coming down, 1 candle, second candle develops. That's when you're going to get that fractal. When it goes 8 points away from that line, what do? You do a couple things. If you're sticking to the strictest of rules, you bring your stop right below that line. If you bring your stuff right below that line, and it does this chop, are you getting stopped out after 8 points? No. So you either got your full 8, 10 points, depending how good you are, or you got 3 to 5 points, and it's bouncing for a period of 3 to 4 minutes here. But this is where the patience game is. Just because it bounces up and comes back, do we have to get out of a trade in 30 seconds? No. You're paying attention to the line. The line says, here's the first touch of the 6. My stop is below this. Does this jostle up and down 5 to 12 points 3 or 4 times? Yes. And then it comes back down close to the line. Then it double fractals off. And then it continues with the continuation move. So think of this as a impulse move. Okay. Consolidation. Continuation of the trade. This is why I want you to learn to get in on the 6s. But even observing our main rules, you are not in any risk of taking a big loss here because you're still bringing your stops just below the fractal line. And in this case, you would have caught a huge portion of a 75-point move. Now, if you wanted to wait for a right-sided pivot rule, you could either go here to here is a right-sided pivot rule with a lower high, or a second touch. This is a right-sided pivot rule. You could try.
I don't know what a pivot move is.
A right-sided pivot rule. Okay, this is what a right-sided pivot rule is. Price is coming down, and I get one ball on the line. Okay, so price comes up, price comes down, and makes a low right there on that ball. Price balances up again, but this time it comes down and it makes a higher low. So now I'm getting a fractal right here, and then price continues to move from that fractal up. Okay, this is called a right-sided pivot rule, where the next candle down is a higher low than the one that you're looking to the left on. Right-sided pivot rule, it means from this fractal to the right side, the next fractal that develops is a higher low. That is a sign of strength. That means that's a buy opportunity. Also, what is that for us? This, remember, when we're looking at tops, we're looking for M for murder. On the bottom, we're looking for W's. So many times this will end up looking like a W formation. And now what are we doing? We're breaking out of the W formation. When we break out of the top of the W, if you don't want to buy down here, you can buy here on the breakout of the top of the W.
Oh.
This opposite is for an M for murder. You get an M up at the top, and you break the middle part of the M that's coming down. That's when we start looking to short more, or adding to our short. So now let me continue on here because there's a lot more to digest, okay? This is a really good lesson, you guys. So mute yourself again, guys. Thank you. So now we have to ask ourselves, we just took a 75-point move down. So now we're starting to look at market rhythms, and we're asking ourselves, when do I want to trade? When do I want to counter trade? Do I want to stay with the direction of the trade? So now market does this impulse move up, 4, bounce up. That's a pretty significant move. Do I want to take this? Is this a valid trade here? Well, the first question is we have to ask, did we already tag the line? No, we haven't tagged the line. So can we take that trade? Yes, we can take that trade. So this is a valid trade to be taken right here, again, with no risk, even though it's counter trend. How many points does that end up going for us? Well, it goes pretty significant. I mean, that's a 15-point move down to the 6. But maybe you ask yourselves, would I rather take the first pullback to the 6 to stay in the continuation of the trend? Because now I've gone from red to blue to green candles on an impulse move. I am now developing a 4, 6, and a 10. Now this is the next big lesson. Write this down. Pay attention to this moving forward. If you have a 10 line in alignment with a 6 line underneath it, that aids in the strength and the percentage that the 6 trade first pullback, first touch will be a winning trade. Okay? If the 10 is in alignment with the 6, the first pullback is a better trade or is a higher winning rate than if there is no 10 line. Say the 10 line developed over here. Now I'm going to show you a couple examples of this. Okay? Now, let's just keep talking. We're coming up. We're bouncing. Is this a valid entry? No. Note the location of the 20 bull and bear lines. So now, okay, I have opposing 4, 6, 10, and 15 on both sides. The 20 lines may not be as big of a bounce. Look in here. I have all these lines, 4, 6, 10, 15, and 20 on the downside. On the upside, right, I had the 4, 6, 10, 15, and 20. So now I have 10s, 15s, and 20s on one side, 10s, 15s, and 20s on another. That was a reason that shows you, again, that maybe the first reflection off the 20 is not going to be like what we saw on that Eagle 20 trade, even though we love the 20 trades. In this case, yeah, I'm getting all hot and juicy, 20, 20, 20, but I've got equal lines over here, and I got equal lines over here. It may not bounce like that off the 20 this time. And I don't have a fractal here, so you're not taking that trade anyways. So now we get a continuation of the trade up. So you missed all of this because you didn't take it according to our first touch rules for beginners. So what could you do? Well, now you're waiting to the next line. This didn't provide a fractal. Now you get a fractal up here, and now we end up coming down for a 33-point move. So you're sometimes stuck taking good trades and sometimes missing good trades. Now we come into consolidation. All right? Let's slide it over a little bit.
I have a quick question on the actual exit for that previous trade.
For this one or
up.
down? Okay.
Yeah, that one. So I know, like, you could trail it like on the 6 line or the 4 line, right? I guess, would you look at the previous move to see that, hey, we had a 75-point move down? I'm thinking we'll probably get a 75-point move out of this.
Yeah.
And then start trailing closer when you get to that point. Because I've had that case where I want to get the move, and I set my stop kind of far, but then it ends up coming all the way back and hitting it. And so I don't get nearly as much out of the trade that I could have got had I just moved my stop up and got it closer toward the end.
Yeah, so it depends, right? So let's just talk about confluence real quick. It really is helpful if we know we're going to go from one cycle rotation to another, right? A high to a low or a low to a high. That might help us stay in the trade longer. That might make you trail a little further below. All right? So down here, though, you don't really actually have an entry. If you're sticking by the rules and not catching a falling knife, you can't get in down here. The first place you could really get in is impulse move up, pull back to the 4. The second place you can get is an impulse move up, first trace, first pull back to the 6. Note that the stronger we have come down, then the stronger, and it's going to reverse, the rotation up, that means we're probably going to have a bigger move. If it starts just kind of going sideways, and it's chopping lots of 4s and 6s, then you're in that consolidation move. So having a big impulse move like this is really helpful because you're like out of nowhere. I bet there was a Fibonacci here. I bet there was some structured trade over here. Something was here that made us bounce. Who knows? Maybe it was the MNQ had a line here. Whatever reason. The first opportunity to learn on the turn, okay, is to take this trade right here. If you, for whatever reason, decided to take that because you're a really good sniper, then you're trailing the 6. If you're waiting to trail this and you think it's going to be a really big move, then I trail this, the next line in order, or I trail 12 points below where the current line is. Now, most of the time I follow the next line because usually it's 12 points anyway. So, right, where's 12 points following below this? Okay, it's almost 12 points. So if I was to keep my stop from entry, 12 points from 12 points, right? Where's 12 points? Okay, now I'm here. So the 6 is helping me. But when I get here, okay, staying below, the green line helps me as it gets up here. Right now, you have to start asking yourself once you get up there, well, how many places do I want to stay into or can I leg out? So this is when you start getting in the, if you're thinking, if I'm like, hold it, maybe this is a vertical DOS. I'm like, hey, we're looking for 50 points off of this. Then hold one and keep the stop much lower. Then I say, okay, remember I said we're looking for 40 to 70 point trades or a 50 to 100 point trade on the iStructure chart. If you're getting at these areas, 75 points down, and now we're getting 50 points up here, I'm going to start trailing the fractals, or I'll start trailing the 6 closer because I don't want it to pull back to the 10. So maybe I'm the 10 initially, because when you have these larger moves, so here's an example. I come down pretty significantly, 75 point move, and then I have a really good spring up. If I have that good of a spring up, then that means this spring back for this little pullback is going to be stronger also. So I want to let that get it out of its system and then can have the continuation of the trade without getting stopped out. But my rules really are protecting me no matter what. But now I'm looking for 50 to 30, 40, 50, 70 points, whatever it is that we're looking for. Now maybe I raise it to the fractal. So now I come from the 10 to the 6 to the fractal, to the fractal, to the next fractal, to the next fractal. And then when it does this rollover, and you can see what price starts doing. See how much space is between this fractal and this fractal up at the top with this little minor pullback, right? Now you start going this, climbing the wall of worry, climbing. And then we have another little pullback. And then we're getting tighter and tighter and tighter and tighter up at a bigger line. When I see these bigger lines, I know there's probably going to be some kind of resistance. From here to here, there's not that much resistance. So I have a really good chance of going from here to there. So trail it at some, every other fractal or something, because you've already hit the 20. You've gotten a really good move out of here. So you got to just decide how much money are you willing to give back. And that's for you. Maybe you follow the wave. Maybe you follow the 6. At this point, you're splitting hairs because you're making so much money, right? So a lot of different ways to do it. In general, I follow the next line in order until I start getting up to my price points where I'm looking at, maybe I have price levels over here on my iStructure chart that says, yep, coming up to target. I will then take my stop and I'm going to start moving tighter and tighter. Because from here to here to here to here, this is just icing on the cake, right? So comes up, comes down here, bounces up again. I move my stop from, from here. Let's say I was here. Then I move up to here. I'm at the 20 line. Okay, now it goes to that next fractal. I let it bounce, go away from me. Then I bring it to this fractal. Then it goes up and it bounces away from me. Now I bring it to this fractal. And I'll just keep doing that. And then eventually I'm going to get stopped out up here. Did that answer your question?
Sure, thank you.
All right. So now I got a couple more things I want to teach in this lesson. We're getting kind of late, so just bear with me here. So Matt, let's talk a little bit about consolidation stuff, okay? You guys need to study this. So I want you guys to do some research because we see this inside the ISNIPE chart all the time, okay? And this, I'm telling you, is very, very beneficial learning. Make sure you study Wyckoff springs. Because it is designed to trap and stop people out and then continue a move. So if I say, from the left side up here, we're climbing, and then I say we're having a pullback and it's flagging, right? Flagging. That means we've climbed up. We're in that retrace mode. The retrace mode gets into the accumulation mode where now we have a line on top, a support and resistance above us, and it's ping-ponging off until it gets enough momentum that it does a peeky-boo out the bottom, and then it does its spring up. There's multiple different Wyckoff spring formation patterns, and I want you to do some research on what they look like because they will help you on the ISNIPE chart immensely. Okay? In general, there's 4 phases of this. We accumulate, whatever, and then we have a peeky-boo out the bottom. We bounce up. We test the low one more time. Here, Stefan, is your right-sided pivot rule, and then we spring out the top of our consolidation zone. Peeky boo, scare people out, take their stops, spring up, come back, retest one more time, and then do an impulse move. An A, B, C move up or something. All right. This is where I do price discovery. Okay. This is where I may do 1 or 2 micros, exit. But because I think it's going to do this. You know, I may have, maybe this is an AM low to an AM high rotation. Maybe there's other structural setups that are telling me I think we're going higher. Maybe it's my clock, whatever. I usually call it out and I give you an idea of what I think we're going to do. And if I don't, I'll tell you, I don't have a bias. If I don't have a bias, I don't have a bias. Then I just might buy, sell, buy, sell, buy, sell until I get something that proves to me what it is. And then I go with the flow. Now, remember, Stefan, they love fake outs. They love fake outs. So you can see a fake out at the top. You can see a fake out at the bottom. But this is when you're going to get that little sell sweep into sell stops. They're going to take people's stops, and then they add a bunch of money, and then they start impulsing it out. If you got a couple options. If we're in a really slow market and you want to try to do 1 or 2 micros, then do that after it's been proven that we've got a range going. You have to have this accumulation range pattern already be established before you start sniping inside of it. Also know that at some point they're going to try to scare you to think it's going to go down. So everybody starts, because what they do is they go, this is a breakout. I've been going here. So as soon as the breakout happens, everybody starts selling short here. And then what do? They reverse it on everybody. So they not only do they take people's stops that have been coming up from below here, but now they make people think they're going to break down and then they reverse. This is one of the number ways Wall Street takes you out of your trade. By scaring you and then continuing with the trend. So you can price discovery down here. You can wait for a right-sided fractal to occur. Wait for that fake out test happen. Right-sided pivot. Buy the right-sided pivot here. If that doesn't make you happy, wait for the breakout of the top after you've already seen the peaky boo below. Now you buy the breakout up here. Or you get in here and you add here. Now you're adding to a winning position that is going to then go up in the markup phase. We're accumulating. We jump the creek. We break out of this. What formation is this? This is a W. This is a W with a right-sided pivot rule. This is a W also that you will sometimes see, but it's a double bottom. And then it goes. It doesn't always do this. W's can have an equal lower level. They can have the left side be higher and the right side be lower and then go. Or they can have this formation where the right side is higher than the left side. But this is a perfect example of a fake out peekaboo below to a right-sided W breakout formation, breaking out the top for a continuation up. Then what do? We have a couple pullbacks along the way that we buy. This might be the first pullback to the 4, might be first pullback to the 6, might be a full pullback to the 10, and then we're continuing up. Then we get that buying climax that we just showed on the last screen up at that 35, 45, 60 ITS line. Then we start to come down. We get a little accumulation again. What does it do now? Well, 75 points up, 75 points down. We come up here. We do a peekaboo. We have a right-sided pivot test. Fake out, breakout again. Come down, test, and then continuation on the next leg down. Accumulation patterns don't have to be all completely even. They could be in a wedge type formation, spring down, mark up, distribution, mark down. Here's a pattern off of Apple. Sell, 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 sell. What is this? This is where supply exceeds demand. More sellers than buyers. Okay? Then you start seeing the red candles get smaller. They're not all red. We go into a consolidation phase. We have a range. All right? Absorption starts occurring. Now look at this. Here's something where you start seeing volume. What's happening with price here is price is making a new low. What is volume doing? You're having divergence. It had that sell volume, heavy sell volume, into sell sweeps, into taking stops on high volume. Then the volume starts dying down. Then you start absorbing this, and then we're looking for a Wyckoff spring back out. All right. Another example. A lot of consolidation. It does its spring up thrust, peaky boo, retest, sell with the mark down. Accumulates, same thing. Has a peaky boo up top, has a peaky boo down bottom. This is the real one. Takes out stop losses. Okay. Boom. Look at the buy volume here. Buy volume all of a sudden comes in really, higher. Buy volume's increasing. Buy volume's increasing till it springs out. Again, we can test the waters at a couple of these locations. We can buy the breakout. Okay, you could wait for the first pull back to the 4, 6, 10, and then continue up. So what our ITS lines are helping us is find these spots. Another example. Accumulation. First pull back to the 4, 6. Accumulation. A, B, C pattern. Come up here, flag down. A little bit larger consolidation than this little pullback, right? This little pullback here is called a pretension pullback. This is a trend continuation. Maybe we flag down, then we come up and finish the last part of a larger A, B, C move. Start accumulating, peaky boo, right sided pivot roll, break down, first touch of the 4, 6, 10, and then we continue. All right. Now, same thing happens here. Consolidating, consolidating, consolidating. We get that move down that hits the bottom, right-sided pivot roll. We finally break up to move up.
Hey, Crash, I have to get going to an event, but thank you so much. I don't know if you're going to post this or anything so I can catch up on the last little bit of it, but yeah, I got to get going.
Yep, no problem. We'll see you later, dude.
Thank you.
Okay. All right, I'm almost done. I'm going to show you guys one more thing here. Um, 21 June. Oh. Let's get to the 21st. Okay. So this was Thursday. Okay, just some interesting trade setups in here. So Matt, we're getting into the price discovery. Let's say we come up here, we hit off of this larger 45 line, we're pulling back, and now we start going into consolidation. Okay, and we're kind of basing above this 20 line, and we're kind of between the 6, 10 here, 6 and the 6 mainly, and the 20. Now, how many points is this between here? From top to bottom. Okay, this is about an 18-point range that we are moving back and forth on. So if you're on your personal account, really won't hurt you if you're in this range pattern. You start seeing, multiple stops here. Let's say you bought this one, and then it popped up to you, or you bought this one, you were holding it, and you still held one, but it still bounced here, but your price entry was here. Now, are you dollar cost averaging because you added again to this spot? Yeah, you got to be careful with that. So again, personal versus prop account on dollar cost averaging, price discovery. If you are using price discovery on a prop account, you don't want to have too many DCAs against you. So really, if you're doing 2 here and you're bouncing up and it comes back down against you, just keep your stop and get stopped out. let it come up, come back down, get a fractal, get back in. The best way to handle the DCA rule is to get stopped out and then just get back in. Once you cancel an order and you get back in 2 seconds later, that whole thing restarts. So you can get out of DCAing by just exiting a trade, enter back in a trade. Exit a trade, get back in, exit, get out, exit, get out. And you're not staying in and worrying about dollar cost averaging in through here. So a couple different ways to handle it. If you're thinking that what you're going to do is break out to the upside, then maybe you wanted to add, pull back, add again, and then you finally get a little bit of a move out. I don't know. It's kind of for you on how to do it. But when I see ranges that are close to 18 to 20 points, all right, I will start sniping. And I will take lows to highs, lows to highs, lows to highs. Now, which way do you think...
Sorry,
Yep.
didn't cut you off.
Go ahead.
On Ninja Trade, there's a where you can instantly reverse your trade. So if you're going long and you think you've reached the apex and it starts going down, you can hit the reverse button and start going short and vice versa. Does anybody have an answer, whether it's valid with apex or what?
So you can do that. Okay, so let me answer that. Almost all platforms have a reverse button where you could do that. I could hit buy here. When it gets up here, I don't have to hit the sell market button. I hit reverse. Now, a couple things about that. Yes, you can do that with Apex. However, the friend that... so the first thing about why you may not want to do that is you only want to do that if the market's moving really fast and you're more than 15 to 20 points between ranges. And the reason is because when you hit reverse, you probably get the worst spread that you can possibly get because you're exiting out of a trade and they're going to give you the worst market order up here, and then you're getting into a reversal trade with however many lots you have, and now you're getting the worst sell price that you can get. So you end up, so if it's a tighter range, that does not work well. So you're going to eat yourself up in commissions and you're going to get smaller points out of it because of the slippage and the wide. So the other thing is, I have a friend, that this gal that I told you that I taught how to use the system. She's probably the best person on this system that I've ever trained, and she will snipe line. I mean, she's so good, it's unfreaking believable. She did it with 20 Apex accounts, and all valid trades, was doing just that all day long, and they wouldn't give her a payout. And they came up with some bogus rule on why they wouldn't pay her out. I don't know what the situation is. I don't know why. It could be that they couldn't trade copy that kind of pattern, and so they are trying to force her not to do that because it is very hard to trade copy in and out, in and out, in and out. I don't have the full answers on that. But if you are doing that with a lot of Apex accounts, you may have problems with it. So you may not want to do that reversal type thing quite as much. You may want to wait for onesies and twosies so that they don't see that pattern and it gets flagged. I don't know what it is that flagged him. I can only tell you she's an absolute amazing trader, like the kind that can pass 20 Apex accounts in a day. She did this very thing, 50K accounts, 20 of them, all in one day, did straight 10 days, went to go get a payout, and they said, no, so you can't do that. And I don't know exactly why. She can't figure out exactly why. So
I just saw a post this morning of somebody who's the number of contracts he trades in the morning are different than the number of contracts in the afternoon.
Yeah, so maybe that was what they got her on. Because she does do it more when the volatility is there. Because once you get into the slog, you're not moving as fast, and you don't get as many points out of it. So, you know, see what I'm saying is that they have all these different rules that they can try to get you on. If they don't want to pay you, they can find a way not to pay you. So the key is to become consistent. Go with these base hits. Do a couple price discoveries, but don't be like killing yourself. Just do a couple here and there, trying to wait for the breakout action. All right. Now, I want to show one more thing, and then we'll call it for today. I want to go to the 21st at... Okay, the 21st at 9:30. So the 20th, what day was that of the week? It's Thursday, right? Did people think Thursday was a tough day to trade? That's when we went down 400 points. Anybody particularly think that was a hard day to trade? In general, I thought it was harder because it's just flushing without you, right? And you're trying to find places to get in. But I just want you to see the statistics of this, okay? The statistics without hardly any risk, okay, on Thursday was 17 valid trades out of 20. 3 were not valid for trying to counter trend trade, and it just didn't move at least 10 points. 85% win rate. Even if you missed that 400 point sell-off, just taking our trades, we still had 20 trade setups, 17 valid successful trades for an 85% win rate on a day that lost a 400 point move and hardly seemed like you could get in. But if you're just looking at the bigger lines, okay, there are places to trade inside once it settles down. So the other thought process is this: in the morning, that first hour and a half, when it's the best time to trade, but when it also sometimes moves the largest and you can't catch that trade, well, wait for the dust to settle. Don't catch a bottom. Don't catch a falling knife, and just start trading these moves. And you can see, man, I mean, look, this is at 11:30 in the afternoon. The trades are unbelievable. You're getting ranges, right? 30 points. It's crazy what these trades can give you. Okay, by having the patience, 66 points. So, Legan, once you learn the system and trust it, look, there's no risk. There's no risk. There's no risk. None of these fractals are causing you risk. You see any of these that have any risk on? This is on the 400 point move down day. Okay, here's one. It's a tough one. Are you really going to short this after an impulse move up, consolidation, and you got all these bull lines underneath you? Do you really want to short that? Probably not. You're doing 4s and 6s, 4s and 6s, 4s, 6s. Probably don't want to short that. But if you do, okay, that's one invalid trade. Actually, it went 11 points. So it wasn't actually an invalid trade. It just looked so small because the days were the range was so huge. That's an 11 point move. So actually, according to our rules, can you get 10 points out of that? Yeah. Here's a peeky boo coming up. Consolidation. Here's our markup. Here's consolidation. Here's a peeky boo out the top. Retest. Right-sided pivot roll. Breakdown. Okay, that's a Wyckoff spring. We just showed that. Boom, 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 boom. Peeky boo. Bounce. Retest. Bounce down. Take everybody stops. Double topping up here. Lower highs. Last thing. Going to the 21st. I want to reinforce taking 6 trades. Okay? So that as you get better, you can start catching more points on the day by getting to the point where you can start taking some 6 trades in the future. Okay, here we go. Now, here's a pretty big drop. You get a 4 and a 6. This touch of the 6 up here, we do not have a 10 above it. But we continue to go down 4s and 6, 4s and 6, 4s and 6s. Okay? This touch of a 6, second touch, we have a 10 in alignment with the 6. Might be an area to consider getting in on this big, huge sell-off. Okay? Look at this 10 down here. We've been in a big sell-off. We don't want to catch falling knives, so we want to wait for 4s and 6s. You have the 4 and the 6, and yes, you have a bigger line having support, but I don't have a 10 line below me. And what does price do? It keeps coming down. Okay? Okay, here we're getting out of the bottoming, out of this big move lower. We're in the bottoming process. We're getting 4s and 6s. No 10 below this yet. We sweep through this one. That doesn't really apply. Consolidating, consolidating. Waiting to base to go ahead and finally pop out maybe a little bit more. Now, 4, 6, 10. 4, 6, 10. Look at the difference between this 4, 6, 10 and this 4, 6, 10. This 10 is underneath this first touch of the 6. So we consolidate it. We're not, remember, we're not catching falling knives. We want to see 4s and 6s develop. If I wait till I see a 4, 6, and a 10 develop, and I take the first touch of the 6, you're going to get your 10 to 12 points at least out of that. Here's a 4, so now we're topping again. 4, 6, no 10. Still a decent move. Oh, that's the end of the day. Okay, we don't really trade right into the close off of this. But you guys understand what I'm trying to show there on that? There's places to take the trades. So, one last thing, okay, that I want to share. Let me go back to this. Okay, this is what I just showed you. 10s over the 6s, trying to get in on these large 100-point moves. If you see an ace line or a double ace line, okay, or one of our gold lines that has a daily price target on it, and we have gone up there and we've hit it, either down, low, or up high, at the lows or the highs, and you see a rollover like that, okay, at some of those extremes, the aces, the T-maps, the Mustang, okay, mark this down, mental note, the ace trades, the T-map, the Mustang. When we are bouncing off of those and coming down, and you see a 10 develop above the 6, you want to get into that 6, because that's how you're going to potentially catch the 100-point move or the 70-point move, where it never goes above the 6, never goes, above it. In this case, okay, bad example. This is not the first part of the sell-off, but you know what I'm talking about. So where you want to get in on those moves that are really, really long. Now, let's go to this, and let me show you.
Hey, Kelly, I gotta hop on.
Okay, sounds good. See you, bro.
All right, see ya.
All right.
Thank you so much
Yeah,
for today.
you too.
Really appreciate you.
Yeah. Anybody wants to go? I'm going to be here 2 more minutes. Let me just show you this, guys. Anybody can stay? You got to go? Let's go. It's fine. I'm going to be on for 2 more minutes. This is the absolute last thing. Okay, for those that want to stay, I want you to watch this. Okay? So, I want you guys to pay attention to those Mustang lines, okay, and the Eagle lines. Come on. Why will it not trade number? Go to this slideshow. Hold on. Get out of this. Go to Mustang. Slide from current show. Okay. When you're looking at the eye structure chart, okay, the eye structure chart, I want you to pay attention when we have these big, huge 300-400 point moves. Okay, what happens on a lot of these? I want you to pay attention to the white Mustang line. Okay, the white Mustang line is a very important line for support and resistance. But once we break below, the guns cloud breaks below the base cloud. The base cloud is defined by the yellow and the red line. The guns cloud is the fuchsia pink, lime green. When the guns cloud crosses below significantly, and then we have a pullback up to a first touch of the eagle, that's when you're going to get a bounce. When we have a first touch up to the Mustang line, you're going to get a very significant bounce. On the days where we're having, okay, big, huge 200, 300, 400 point moves, it's on days where we hit things like T-map line here, 3 times standard deviation moves. Okay, when we have major price targets and we finally are moving against that big move that we've already had, and we have the guns cloud cross above the base cloud, watch these Mustang lines. If they happen really early in the morning, they're very key. Okay, they happen all the time where you get the Mustang line giving you support. Down here, we had it where it came down, crossed above Mustang line, bounced back up. Here we have Mustang Ace, Eagle, and Viper resistance. So we had double Ace up here as resistance. Price came back down. We cannot really break that much above the Mustang line. We do a little bit of choppiness. The guns cloud breaks down below it again. And then we have a lower high. Okay, double topping pattern with a lower high off the Mustang line, and then we drop significantly again. So and look at this, is at 7:30 in the morning my time. So just something I want you guys to pay attention to off the eye structure chart is when we see the guns cloud cross below the base cloud early in the morning, we want to look on the ISNIPE chart and look for those patterns where I was trying to show you where you might want to get in on the 6 that occurs after an Ace line or after a Mustang line, because that's when you might be able to write it down for a significant number of points. All right, that's the last thing I wanted to show for today. Anybody have any questions of anything that we went over?
No, that was the most helpful training. Thank you.
All right, well, everybody have a great rest of your weekend, and we plan on seeing you guys Monday morning.
All right, thanks, Crash.
Thank you, sir. Have a good one.
All right, guys.
Thank you.
Yes.
Cheers. Bye. Crash out.